So the largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates probably through the remainder of this year, but then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance.
American lawyer, economist, and investment banker Jim Rickards is a notable name in the world of finance. With over 35 years of Wall Street experience, Rickards has extensive knowledge of finance, economics, and the global macro environment. Since the United States had 2 negative quarters of GDP growth, the former investment banker has maintained that the world's largest economy is in a recession. Apart from having met the standard definition of a recession, Rickards believes there are other notable signs of an oncoming prolonged economic downturn in the markets. Without mincing words, Rickards thinks the U.S. economy is about to go into a severe recession that could last for another 2 years. Earlier in the week, the U.S. Federal Reserve announced a third consecutive 0.75% interest rate hike. Fed Chair Jerome Powell also rolled a situation update on the U.S. economy, basically informing investors to prepare for the coming storm. According to Powell, to finally tame the 40-year high inflation, the country is going to have to deal with slower growth, higher unemployment, and potentially a recession. He also acknowledged that the Fed's previous goal of ensuring a soft landing looks increasingly unlikely. The chances of a soft landing are likely to diminish, Powell said during a press conference on Wednesday. No one knows whether this process will lead to a recession or, if so, how significant that recession would be. The U.S. central bank will also be dumping $95 billion off its massive $9 trillion balance sheet starting from September, all in a bid to achieve its 2% target. In a recent interview, Jim Rickards discusses the general state of the markets and the economy and how everything points to a prolonged, severe recession. We will now take you to Jim Rickards' interview. Please watch the video to the end, smash the like button, and drop your comments and observations about the interview in the comments section below. Also, ensure you subscribe to the channel and turn on post notifications for more videos like this. Thanks, and enjoy the video. Let's dive right in.
So when Deutsche Bank needs a little money and they borrow from JP Morgan, or Citi lends to Credit Suisse, or however, UBS, Unicredit, however it plays out, that's all in the Eurodollar market. But the rates are very short term, overnight, 1 week, et cetera. But that's what banks use to leverage their balance sheet. That's what banks use to support their derivatives positions. That's what banks use for collateral. And if I'm going to have a derivatives position, I have to give you collateral. And this symptom of a liquidity crisis is when you say, yeah, okay, Jim, I'll take the collateral, but I only want treasury bills. I don't want your junky mortgages. I don't want your corporates. If you give me a 10-year note, I'm going to give you a 1-point haircut, which is a lot. I want 30-day bill. I want your best, absolute best collateral. And even then, there's a little bit of a haircut. So if I have to get that collateral to pledge to you to leverage my balance sheet so I can make money, I need dollars. If I'm Deutsche Bank, I need dollars to buy treasury bills. Can't buy them with euros. And this is the secret of why the dollar is so strong. Everyone's like, wait a second, you guys got, multi-trillion-dollar deficits. You got 130% debt to GDP ratio, which is about as high, almost as high as Lebanon. Your budget's out of control. Your inflation's out of control. Your politics are dysfunctional. Everything's bad. Why on earth would the dollar be so strong? The answer is, behind the curtain, people need dollars to buy dollar-denominated collateral to support their balance sheet. So that's the secret driver there. Now, what's going on with the Eurodollar futures curve? Now, you can trade Eurodollar futures on the CME, and they go out, I think they might go out to like 8 or 9 years or 10 years. But most of the liquidity obviously is in the early months. But the 2 and 3 year, 4 year futures trading is relatively liquid. Certainly 2 years is very liquid. And they settle monthly, and then as you get to long maturities, quarterly, et cetera. So there's a Eurodollar futures curve. Now, how to think about this, and this is interesting. These are long-term bets on short-term rates, right? Because if I buy a Eurodollar futures 2 years forward, I'm making a 2 year forward bet on what overnight rates are going to be 2 years from now. So easiest way to understand it, long-term bets on short-term rates. The Eurodollar futures curve is inverted. Again, normally sloping at the short end, and then it goes inverted, steeply inverted. So that's telling you that not only does the Treasury market think 10-year note yield to maturities are going to be lower 2 years from now than they are today, but the Eurodollar futures market is telling you overnight rates, the rates the Fed does control, are going to be lower 2 years from now than they are today. And just to make it worse, that kink, the inversion point, the inflection point, is moving in. Like we had this conversation 6 or 8 months ago, I would have said, hey, Brian, 3 years from now, the curve's inverted. Well, it's becoming in 2 years. Now the inversion starts, the inflection point is kind of January 2023.
In another interview, Rickards explains that the U.S. economy is not only in a recession, we are also all possibly facing another 2008-style liquidity crisis. The veteran investment banker states that the U.S. could be facing another quarter of GDP growth decline, which would finally kill all doubts of a recession or otherwise. Please listen as the renowned economist discusses the current state of the U.S. economy and the factors that contributed to the decline.
Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything, because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like, it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily, after the election. But we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But they say, okay, here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number. But they don't guess at the stuff they don't have. And it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 0.2 or 0.3, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP is sky high, economy weak at best, probably out of recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working. Prime age, 25 to 54 years old, who are not in the workforce.
Yeah.
That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not, taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, if we have the deficit, where the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act,
Right.
and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion.
Yeah.
2 for Trump. That's 6 on top of 2 baseline. That's $8 trillion in 2 years. So your deficit's out of control, and your trade deficit's out of control.
Jim Rickards is not the only economist predicting a 2008-style liquidity crisis. Economist Nouriel Roubini has also warned of a global recession, which he says would be long and ugly. He believes the global recession will begin by the end of this year and probably last all through 2023. Among other things, Roubini is famous for correctly predicting the 2008 financial crisis in 2006. His on-spot prediction of the housing bubble crash of 2007 to 2008 earned him the nickname Dr. Doom. He is back with another gloomy prediction and was quoted to have said rate hikes will kill off many zombie institutions, households, corporates, banks, shadow banks, and zombie countries. Roubini, who is the chairman and CEO of Roubini Macro Associates, also said, even in a plain vanilla recession, the S&P 500 can fall by 30%. In the long and ugly recession he is predicting, he expects a hard landing that could plunge the popular stock market index by about 40%. Roubini also noted that the 2% inflation target without a hard landing would be mission impossible for the Federal Reserve. In addition to the existing problems, Roubini believes the global financial crisis could escalate into a 70s-style stagflation, a deadly combination of slow growth, high unemployment, and high inflation. We believe the road to recovery will be long, hard, and quite torturous due to the insanely massive debt in the system. What is your assessment of the future of the U.S. and global economy? Do you think this next recession could be the final straw that breaks the existing traditional finance industry? Let us know what you think in the comments section below. Also, ensure you drop your thoughts and observations on Rickards and Roubini's predictions in the comments section below. If you liked this video, then ensure you smash the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.